This is Scott Becker with the Becker Private Equity Business Podcast. We join you daily with short business episodes, short private equity episodes, as well as interviews with brilliant business and private equity leaders. We're joined today by Rick Kes, partner at RSM. RSM, sort of the middle market leader in private equity, just a fantastic consulting and advisory firm. I think the fifth largest accounting firm in the world. Rick, tell us what you're seeing in the private equity space currently. Give us a sense of what you're watching.
Yeah, Scott, thank you for that intro. And, I appreciate all the kind words you said about RSM and what we do in the middle market and in private equity. And I think, I think for what we're watching, obviously, not much different than I'm sure things other people are watching: interest rates, jobs, inflation, things of that nature. And, like last week, the jobs report, I think, was fairly good in our perspective. I think we were a little surprised in a good way with the number of jobs that were added in September. And I think that I think our economists team, they really look back and say, when jobs reports are better than expected, we know what happens, what are the impacts to rates setting and all that kind of stuff. And I think their research would say, likely that it's a good thing in terms of, giving Chairman Powell the fuel and the confidence that the rate cuts aren't impacting jobs being added to the economy and growth happening there. So I think as we look at it, holistically, kind of using the data points of jobs and inflation, I think our perspective is that this is good news for people in private equity, that it hopefully means another rate cut coming, in the next FOMC meeting, coming up here not too long from today.
Do they think they'll go slower in rate cuts because the jobs market is so robust, or what do you see there?
Yeah, our economist put a note out late last week saying that he's expecting, 25 basis points cuts over the next, few meetings, into 25 and maybe even in 26 to bring us down, closer to that, high twos percentage. So, yeah, I mean, I think it will be slow and steady, hopefully, or at least he thinks it'll be slow and steady. And I think his data and everything helps support that perspective, and the kind of historical look backs to say what happens, when and all those kinds of things. So, yeah, I think it will be, relatively slow. Won't, I think the last meeting where we cut, 50 basis points, I'm not, we're not projecting that into our kind of forward looking thoughts around the interest rate environment. But we do still think that interest rates will be continuing to go down, and hopefully that again, puts all the dry powder that's out there to work. And I think we've been talking about that for a long time. Is that our optimism kind of comes steads back to how much money private equity funds have to invest in, how eager they will be to do that, put that money to work once the interest rate environment isn't such where they're able to do so.
It seems like the largest funds are already back at it with a vengeance in terms of investing. Is that also coming down to the mid-size and smaller funds too, or is it a little bit slower getting going at that level?
Yeah, I think, it comes down to, lots of things. It comes down to, what risk appetite you have. And, I think sometimes, not always, but sometimes the larger you are, the risk appetite that you have could be different. So I think that taking on maybe some interest rate risk is okay if you're able to kind of, I'd say, hedge it to some extent on some other investments or some other things that you have going on. And just from a resources perspective, larger firms have tended to have more of those levers to pull. So that's, I think, why you see larger funds perhaps doing things quicker, faster than your traditional middle market funds. But yeah, I think we're starting, we continue to get lots of interest for, deal advisory services, both buy side and sell side. And so, I think the deals that people want to happen, I think are ready to go. And I think it's just a matter of timing for some of these to get past perhaps the election, maybe another rate cut. Some of these things will start to kind of push the snowball down the hill, if you will, and hopefully get some of that traction moving in the core middle market, as well as where we're seeing kind of in the high end of the market right now.
It seems like there's both pent up demand to buy stuff, to invest, but not moving that quickly at the mid market. But there also must be pent up demand to exit some stuff. What's the perspective on funds and founders looking at exits or transactions from that perspective? What do you hear there?
Yeah, I think on the exit side of the house, I think we see, a lot of people kind of taking the perspective that sellers' expectations have to change, that the 21, 22, that those years, that, if you're basing your exit price multiple off of those data points, that you might be kind of misguided in some respects. But I think it's hard to say. I think everybody has different perspectives on their own business, and whether they're founders or they're the first time institutional investors in a company. They may see things that obviously people can't, because of their intimate knowledge of what's going on, what the trends are, where they hope to grow to, and all those things. So I think just like anything, using a multiple to kind of base your valuation sometimes it gets a little tricky just because, it's obviously facts and circumstances driven versus, core just, benchmarking, if you will. But, I do think that the companies that, continue to be growing and have great management teams and, have great, sophisticated business processes, those companies still, go to market, and there's still lots of people very, very interested in buying those companies because, they're easy to scale, they're easy to grow, or I shouldn't say easy, they're easier than maybe other companies that maybe don't have that infrastructure or sophistication or things of that nature. So, at the end of the day, I do think that, I've said this a million times, that strong, high performing assets continue to be very, very attractive, and buyers are still, very, very intrigued in those marketplaces.
Does seem like we're coming back to that confluence or convergence of buyers ready to buy, sellers ready to look at the market as well. And you're probably right. There's still probably some expectation or hope that multiples will come back a little bit. But there's also some concern from those sellers about, depending on, it's a broad array of where those businesses are performing. So fascinating different facts that go into, and you're very right that each decision is very individually driven, not just market driven. I think that's exactly right on. Rick, I want to thank you as always for joining us on the Becker Private Equity and Business Podcast. You're one of our most listened to guests, and we appreciate you joining us and sharing your expertise. Thank you for joining us today.
Thank you, Scott.